Okay, hi everyone. Welcome to today's webinar. Apologies for the delayed start. We had a bit of technical issues, but we are back and running. So let's go ahead and get started. Um, okay, if you have any questions, feel free to just pop them into the chat or in the Q&A section as well. And if there are any issues throughout the webinar, feel free to just let me know as well. Okay, yeah, let's go ahead and get started. So as per usual, a risk warning and disclaimer first. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. Okay, let me just check my audio to make sure that it's okay. Is it bad for everyone as well? Oh, okay. Is the audio still bad? Bridget, because other people are saying that it's fine. So it'd be okay now, I think. But if there are any other issues, feel free to let me know. Okay, so disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. Yep, and if you guys want to find me on LinkedIn, it's just my name as well. Yep. Oh, okay. No worries. I'm glad it's working for you now. Okay, so here's our agenda for today. We're gonna firstly look at what exactly are candlesticks, and then we'll look at reversals versus breakouts. Then we'll do a kind of brief revision of what we went through last week from our price action masterclass, where we'll just go through a couple of top candlestick patterns since we are talking about candlesticks in this webinar. And then we'll jump right into our top 3 reversal patterns. And then lastly, we'll look at improving the probability of successful reversals and how we combine all of what we've learned from this webinar, from the patterns and all of that, how we combine those with what we already know, which means our Fibonacci, our indicators, so on and so forth. Okay, so let's go ahead and get started. So firstly, let's look at the anatomy of a candlestick. So for a bullish candle, we have the high price, which would be the top of the wick, the candlestick wick, and then the closing price would just be the start of the wick. Open price would be the bottom of the body of the wick, not wick, sorry, the body of the candlestick, and then the low price would just be the end of that wick. Bearish candle, of course, would be the opposite, where we have the high price at the top of the wick, open price at the top of the body, close price at the bottom of the body, and low price at the end of the candlestick wick. Okay. Yep, so this is closely related to what we talked about last week about our price action masterclass. So let's look at our reversal and breakout. So for our reversals, we mainly look at it could be like a bounce off of the end of our here we have an ascending trend channel, so it could be that. And here we have a morning star formation. So in combination with our ascending trend channel, once you have both that give you confirmation of a reversal, then we can expect price to reverse off of the end of our ascending trend channel and give rise even above that ascending, or rather that support line. So I'll go through this a bit at the end, but basically when you have a swing high and a swing low that are in the same line up in the same area like we do here, this is basically what we call an overlap resistance. So here our overlap resistance, you can see, has been surpassed by that reversal. So that's why it's important for us to look out for reversals, so that because reversals tend to be pretty strong, especially in combination with your ascending trend channel as well as a candlestick formation. Next, let's look at a breakout. So breakout basically can occur from a resistance point of view, or breakout out of an ascending trend line, or ascending trend channel. Here we're looking at a breakout through a resistance area. Okay, so here we have again an overlap level. So you can see our double swing high resistances are in line with that tiny little swing low there. And we're expecting resistance area to break through that area. Let's see, that's exactly what happened here. Okay, and what we have is 3 white soldiers. That's the name of this candlestick formation, which we'll go through in a little bit as well. So once we have this formation, along with that breakout of the not ascending, but this overlap resistance, then we have confirmation for a breakout. Okay, now let's look at our top 3 single candlestick patterns. So we're going to start off with single and then double, followed by lastly our triple, and then we'll get into the candlestick reversal patterns. Okay, so our top 3 single candlestick patterns, we have the hammer, which is a reversal technique, bullish reversal technique. You can see prices moving from a downtrend into an uptrend after the formation of this hammer. So it's basically a shorter, or rather a longer lower wick, accompanied by a really small and short upper wick. The hanging man, of course, is the opposite of that, gives you a bearish reversal with prices giving from an uptrend, it then reverses into a downtrend. So it's pretty straightforward. Next, we have the inverted hammer, which these two are pretty similar to what we talked about previously with the hanging man and hammer, but it's kind of the opposite. So here for our inverted hammer, it's a bullish reversal technique. So, but the shape, you have a longer upper wick and absolutely no lower wicks at all. Conversely, for our shooting star, we have a longer upper wick and no bottom wicks at all. So they're basically exactly the same, but how you identify them would just be the trend. So moving from a downtrend to an uptrend and moving from an uptrend to a low trend. And of course, the color of the candlestick as well. Okay, lastly, the last most popular candlestick pattern would probably be the doji candlestick patterns, which are just represented by this kind of T shape. So your dragonfly doji is represented by this T shape. The gravestone doji is just an inverted T shape. So again, the dragonfly is your bullish and your gravestone is your bearish candlestick reversal pattern. Okay. Now, let's look at the top 2 double candlestick patterns. Okay, we have bullish engulfing, bearish engulfing. There's not much for me to say about these two. It's pretty common and pretty easy to spot. Your this area, I'm not sure if you can see my mouse. Okay, yes, you can. So the bottom area for your bullish engulfing candlestick simply has to line up for both of these 2 candlesticks. And your second candlestick just has to surpass the head of the first candlestick, if that makes sense. From your bearish engulfing, it's just the opposite. So the head of your second candlestick just has to line up and the bottom of your candlestick has to surpass the bottom of the first candlestick. Okay, next we have the tweezer bottoms and tweezer tops. So tweezer bottoms are your bullish reversal candlestick patterns. They are exactly the same shape, just that they're a different color, and moving from a downtrend into an uptrend. Tweezer tops, just upside down of the tweezer bottoms, moving from an uptrend, reversing into a downtrend. Okay, now moving into our top three triple candlestick patterns. Here we have our morning star pattern and our evening star pattern. I don't really have much to say about this. It's just a long candlestick followed by a smaller one, and the smaller one should resemble this. So top of the top of the middle candlestick and the bottom of the wick should be kind of the same length. Okay, that's just the important point here. And the start of the morning star pattern, so the bottom of the candlestick, should be kind of lower than the first candlestick that we have here. Okay. Yeah, it's just the opposite for the bearish reversal pattern, your evening star pattern. Okay. Now we're gonna look at your 3 black crows and 3 white soldiers. It's just basically three identical candlesticks lined up lower than each other. Not really much to say about these two candlestick patterns. Your 3 white soldiers, it should just kind of resemble one another again, but giving you an uptrend. Okay. And lastly, we have the 3 inside up and 3 inside down patterns. So your 3 inside up, the first 2 candlesticks, the bottom of the body of the candlesticks should kind of resemble, or rather, the bottom of the candlestick should be around the same area. And the start of your candlestick, the last candlestick, should occur after the body of the first candlestick. Okay, similarly for your 3 inside down, you can see the top of the candlesticks line up. For your last candlestick, it should kind of start a bit below the other 2 candlesticks. Okay. Okay. Now let's look at the top 3 reversal patterns. So first we have the head and shoulders pattern. So the head and shoulders, we have the top and the bottom. We're going to look at the top first. So the pattern basically appears as a baseline with 3 peaks. That's what we see for head and shoulders. So where the outside to the left and the right shoulder are kind of similar in height, and the middle, the head is the highest. Okay, so this pattern is formed when a currency or securities price rises to the peak and then it declines back to the base of the prior up. Then the price rises above the previous peak to form that head that we see here, and then it declines back to the original base. Okay, finally, the securities price will peak again at about the level of the first peak of the formation before it falls back down. Okay, so this pattern is typically considered one of the most reliable trend reversal patterns, and it's one of several top patterns that signal with varying degrees of accuracy that an upward trend is nearing its end. So you can see your target would be below that. Yeah, your target will be below the neckline of the left shoulder and right shoulder. Okay, here this first line that we have here kind of just points out that price is moving in an ascending trend line. Okay, so just to recap, an ascending trend line basically occurs when there are 3 touches on the trend line. Here we have 1, 2, and 3. And you can see price, once it reverses from the hit, it surpasses or breaks out of that ascending trend line. Okay, and then bounces off of the neckline, heading up and forming our right shoulder. Okay. Okay, now let's look at our bearish. It's basically the same, just the other way around. So in this case, we are looking at a bullish reversal trend with price moving in a descending trend line here, breaking out of it, and moving in an uptrend here. Okay. Okay, now the second pretty popular reversal pattern is the double top. So the double top is a reversal pattern that's formed by 2 consecutive highs that are kind of around the same level. If there is a slight difference in the values, that's okay, but they should be around the same level. Okay, and there should be an intermediate low in between them. So it's expected that after the price again reaches the level of the first high and then reverses and falls below the level of the intermediate low, the fall will continue further by about the difference between the highs and the lows. So that's why our target is over way below here, because we're expecting that kind of similar difference between the two. So the pattern is considered formed when after the appearance of the second peak here, um, the price falls below that neckline and this dotted horizontal line as well. So we label it as the target label, which indicates that the expected price level after the pattern has formed. Okay, so yeah. So this is kind of what it looks like on TradingView. And here as well is your double bottom. It's just the opposite of your double top. Again, this would give you a bullish reversal pattern. Okay, your target would be up here, kind of around the same number of bars as the difference between the peak, or I guess in this case would be a trough to the target area. Okay, lastly, we're gonna look at your triple tops. So the triple top pattern you can see here is pretty self-explanatory. We have 3 swing highs that are kind of testing around that same resistance area. So the triple top pattern shows us that the price is unable to penetrate the area of the peaks or the swing highs. So if we're talking about real life events, it basically means that after multiple attempts, the asset is unable to find many buyers in that price range. So as the price falls, it puts pressure on all those traders who bought during the pattern to start selling, which is why we kind of see that downtrend instead. So if the price can't rise above that triple high or swing high resistance, then there is limited profit potential in holding onto it. So as the price falls below the swing lows of the pattern, selling may escalate as former buyers exit losing long positions and new traders jump into shorter positions. So that's kind of the psychology behind the pattern. Okay, so for this pattern, a I guess kind of a risk management technique would be to place a stop loss on the short positions above the latest peak. So it could be the third peak or above a recent swing high. So it could be, it doesn't have to be one of the peaks. It could be like this one here. Okay, so if you place your stop loss above that swing high within the pattern, this move limits the risk of the trade if price doesn't end up dropping and instead rallies. So the opposite would obviously be true for your triple bottom as well. Okay, so you can see the triple bottom here and price rising over here. That's why we place our take profit here and your stop loss would probably be below that. Okay, so the drawback with your double tops and double tops and bottoms, triple tops and bottoms is that the risk reward ratio is not really ideal. Okay, because reason being, both the stop loss and target are based on the height of the pattern. So they are kind of roughly equal. So patterns in which the potential profit is greater than the risk are preferred by most professional traders. Okay, so by placing the stop loss within the pattern instead of above it, if we're looking at a triple top, here we're looking at a triple bottom, so you probably place your stop loss below it. It improves the reward relative to the risk. So the risk is based on only a portion of this pattern height. So while the target is based on the full pattern height, which you see here. So your risk would probably be just somewhere slightly below it. But again, it also depends on your entry point. So if we're looking at the trend line or the recent pullback low, it's possible to have two profit targets. So it could be kind of an intermediate profit target, just to catch, or rather a partial profit target, just to catch that in case of any reversals, before going in for your take profit. So yeah, you could have two profit targets since the height of the pattern can be added to either of these breakout points. Okay. Okay, so are there any questions so far? Okay, if not, let's look at how we can combine all of these candlesticks with what we already learned. So some things that we've already learned would be your support and resistance levels, like your pullback and overlap that I mentioned earlier. Could be our trend lines, oscillator indicators, and momentum indicators. Yep, you've spotted it. Yeah, so sometimes these candlestick patterns also contain more than one pattern as well. Oh yeah, so yeah, I think everyone can see your comment. Okay, so what was I saying? Yes, so let's first look at a really brief revision on your support and resistance. Um, okay, so I did briefly mention your overlap resistance earlier. But let's just go through this again in case anybody hasn't been to our intro to support and resistance. So support and resistance levels basically refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools like your trend lines, moving averages, chart patterns. So one way to use it as well is by looking at your swing highs and lows. Okay, so that's mostly what we focus on. Mostly we look at the chart, the shape of the market structure. Then we go in with our resistance and support levels, followed by our Fibonacci levels, and then lastly we go in with any candlestick patterns as well as our indicators. So that's normally how we do our live analysis, if you've been here for that. So here's an example of an insignificant swing and kind of movements that are too small for us to use when it comes to our horizontal levels or for any kind of analysis actually. Okay, so here we're talking about Fibonacci points, but they are poor levels, poor charts to use for any kind of analysis. Okay, here's another example. And here's a correct example of significant swings. So there's a very clear move up and down with obvious peaks and troughs and clear market movement as well. So this is the kind of chart that we want to be looking for when it comes to looking for significant swings, candlestick patterns, or any kind of analysis. Okay, so here's an example. So I've drawn out the peaks and the troughs to point out exactly how clear your shapes should be. Okay, so support and resistance levels or your horizontal levels can obviously be used as your take profit targets or your stop loss levels, but you should try and use other supporting arguments as well, such as Fibonacci or pivot points, for example, to support your analysis. Okay, so if at least two swing high or low levels line up nicely, it's a much better level to use. So that's why we try to find areas where these might line up. So it doesn't have to be an exact level, as long as it's near that level, it's near enough. And so it's good practice for us to pull back or see how far back your resistance and support lines can go without cutting too many candlesticks. So you can cut through small wicks like the ones that we see in this GIF here, but you want to avoid cutting too many bodies of candlesticks, which I'll show you in a bit. Okay, so for example here, when picking the starting point of pivot entry, it can be pivot points, but it could also be any kind of resistance levels as well. Okay, so you want to avoid cutting the body of the candlesticks, like I mentioned earlier. The orange sticks here, which represent kind of an okay intersection, that's fine because it's not really cutting through the bodies of the candlesticks, just the wicks. But you want to kind of look for these kind of swing highs instead. Okay, so for example here. So we want to stay away from these kind of candlesticks, with the red thumb. Because this level intersects multiple bodies of candlesticks, and you can see it's a pretty messy cut. So instead, we want to look for levels that have this clean cut of just the wicks instead of the bodies of the candlesticks. Okay, so take note of the red highlighted area. You want to avoid intersecting too many candlesticks there. So in this kind of situation, we would just basically we'll move this to over here instead, and we'll just leave it at that. Okay, so now let's look at the pullback versus the overlap. So your pullback support is a strong level of support. Basically, it's a level that breaks out from previous resistance level, and we're expecting price to now drop back to visit it again. So pro tip is when you are able to line up these support lines with a Fibonacci level, it works pretty well. Okay, so here's an example. You can see the three swing lows. Price broke below that swing low support, and we're expecting it to come back and reverse off of it again. If we look at a pullback support level, it would be a resistance level first. Once price breaks out of that resistance level, it then becomes a support level. Okay, and we're expecting price to reverse off of it. So once price actually reverses off of it, that's when we call it a overlap level. Okay, so let's look at what they exactly are. So here we have our first example. We have a big swing high resistance level. Price surpasses this level and becomes a pullback support, where we expect price to pull back or retrace to this level. In the green areas, we see price retrace this level and bounced off of it perfectly. And once price bounces off the pullback support, it then becomes an overlap support. Okay. Here we have two swing highs lining up. So it's a swing high resistance, and price surpasses this level to become a pullback support. So we can expect price to retrace to this level, The two blue circles here, price has bounced off of that level twice, so it makes it a strong overlap support. Okay, last example. Here there are multiple swing lows that are in line with the 33420 support level. So once price breaks this level, it becomes a pullback resistance. We can see price has tested this level 3 times, so it makes it a strong overlap resistance. And we can see price surpassed it again to become a pullback support. And lastly, it tests that level that and bounced off of it, so it becomes an overlap support. Yep, if you have any questions, feel free to just pop them into the chat. Okay, so let's look at combining this with trend lines. So here we have a descending trend line. So again, to recap, a descending trend line basically occurs when there are at least 3 touches on your trend line. So we have 1, 2, and 3 here. Okay. Here we have a channel. So a valid channel basically occurs when there are at least 2 touches at the top and at least 2 touches below. So if you're able to spot a double top or triple top candlestick formation along with these two trends. So obviously your trend line and your trend channel, these two both are trend indicators. So if price breaks out of either one of these, it's basically a reversal already, like a suggestion, an indicator that price is going to reverse or change in trend. So if you are able to spot any of those breakouts together with a candlestick formation or a pattern, then that obviously strengthens your analysis. Okay, and then what you can do is use that with your resistance as well as your Ichimoku. So earlier we went through a resistance. So here in this example, we have a swing low that's in line with a swing high. So it's an overlap level. And we also have this Ichimoku level here. Okay, so we're expecting price to reverse off of it. Okay. Okay, that's actually it for today's session. I will stick around for a while if you guys have any questions. But if not, that's it for today's session. Thank you guys so much for joining me. I hope you guys found this session helpful, and I'll see you guys again next week. Thanks, everyone. Bye. There are obviously a lot of other um, candlestick patterns out there. So feel free to just pop it into Google and they'll show up, especially if you want to recap any of the patterns that I went through today. Most of the patterns I went through today are pretty popular, so you'll be able to find some examples online as well. Yep, thanks everyone. I'm not too sure if recordings are available. This session is being recorded. But you can email IronFX help. I think that email is on the website. So feel free to just email them and ask for recordings, and I think they'll be able to help you guys out. Yeah. Thank you guys. Thanks everyone. Bye.